Found a pen.
I got into this.
Okay, can you guys hear me now?
Yes.
Yes.
Okay. Okay. So we're going to be talking about bank management, right? This is a relatively short set of slides, but it's important for you to have some idea of how the senior management of a bank looks at things. Now, this is not telling you how to run a bank, but it tells you about the things that they have to be aware of and have to be dealt with. And within any commercial bank, you're going to have somebody in senior management looking at these sorts of things. Okay, so we start by just talking about it in general. This is chapter 19, bank management, in your text. You know, and the performance of any bank depends on the management of the bank's assets, liabilities, and capital. Assets, the loans; liabilities, the deposits, the customer's deposits; and capital, the bank's money. Yeah? So the primary goal underlying managerial policy, every managerial policy or the primary managerial policies, is to maximize shareholder wealth. Now, I need you guys to understand this, because most of you who work in a bank, if you work in a bank, you understand this intrinsically, okay? But let me just make sure it's clearly stated. The bank is in business to make money. It's not in business for any other purpose. Now, if it's making money, it will then take on doing other things that can be of value to the community, as well as to the various stakeholders in the bank. That is, the shareholders, the staff, the customers, the regulators, and so forth. But if a bank isn't making money, it isn't going to be around long enough to continue to do things for the community or for the government or for the staff or anything like that. Okay? And so when we say the primary goal, we're not saying that there aren't other goals. We're just saying that if you're not making money or maximizing your shareholders' wealth, right, you're not going to be around a very long time. Okay? Now, I'm using a more layman's term when I say the bank's primary objective is to make money. The primary objective in economic and finance terms is to maximize shareholder wealth. Shareholders are the owners of the bank, right? They have invested their money into the bank so that they can get a return on their money, okay? And management's primary responsibility is to maximize that return. That means increase the stock price if it's a publicly traded company, okay? And so if you think that that is not the primary rationale for a bank, then you're going to have a very difficult time, right, working with a bank. If you think that they're there to ensure that people are employed, to ensure that the depositor's money is protected, to ensure that the management gets a good bonus or something like that, no, all of those things are secondary, okay? And the reason they're secondary is very simple. If you don't maximize your shareholders' wealth, you will not have any shareholders, okay? Nobody's going to invest in your business if you can't get a return, okay? So when a bank starts to deal with the management of its resources to maximize its shareholder wealth, right? The first thing they have to do is they have to start talking about management of its source of funds. That's called liability management, right? And then management of its uses of funds. This is so basic, and we've been talking about it in different ways all throughout this course. But if you come away from this course with two things: one, maximize shareholder wealth, and two, how do you manage the sources and uses of funds of a financial institution, in particular a commercial bank? Okay. And this is, I cannot strive, and I cannot tell you all how important this stuff is, right? No matter what the bank says, no matter what they write in their little letters to their stockholders, in their annual reports, in their marketing pieces, all of that, right? None of that matters if they ain't maximizing shareholders' wealth. Okay? So let's give you an example of what I mean. How many of y'all would consider purchasing shares in Bank of the Bahamas? Raise your hand. Ms. Knowles said no. She's shaking her head. Carla? Martine? Shawnette? Kelia?
No, I wouldn't.
Angelique? Angelique?
Wouldn't either.
No, I wouldn't buy.
No,
Ange-
I wouldn't.
Okay. All right. How many of y'all would consider if if Scotiabank Bahamas was to be publicly traded, how many of y'all would consider purchasing shares in Scotiabank Bahamas Limited?
I wouldn't.
You would not.
No.
Colette, you would not. Sorry, Carla, you would not.
No.
Okay. All right. Anybody else? That's it? Everybody would not consider purchasing the shares in Scotiabank Bahamas?
I'd buy it, Scotiabank.
Colette, you would buy it. That's two. How about you, Angelica? Not Angelica. Angelique. I'm so sorry.
At this time, no, to be honest, because if you look at how the economy going, we just closed a few branches.
Okay, fair enough. Kelia? Dominique? Shawnette?
No.
I said no.
Okay. So, I have a question for all of you all then. Why? Angelique gave hers, right? Because she thinks the bank is closing branches and the economy is bad. Okay. Why
I would
won't you?
buy because they're closing the branches. They're decreasing their operations. So they're putting more money in provisions to pay out to the shareholders. The more they close, the more money they save to pay out to their shareholders, and they are combining jobs and lowering the amount of staff, and they're also going digital or electronic, sorry, yeah. So they are saving monies to pay out to the shareholders, and the shareholders are kind of feeling more secure in the fact that, okay, so you're doing all of this, you're downsizing on the operation and on the liability side of operations. So that means you're going to have more money to pay out to me.
So what if they decide to pull out? What if they decide to pull out of the Bahamas?
Their parent company will have to pay out. They are part of a bigger organization.
First Caribbean is part of a bigger organization and it's publicly traded. It's exactly what Scotiabank Bahamas would be if it was to go public. Okay, the point I'm trying to make here is the point I'm trying to get you guys to consider is, right? Not once in there did you talk about the management of the bank and what they did and how they did it or anything. What you said was, right, Bank of the Bahamas, no. But there's an implicit assumption that because the government is involved there and they've had so many bad years, that they're going to be like that for a little while. And then for the Scotiabank side, you're basically saying, well, it looks like they may be pulling out. Yeah. But Colette has a point. Even if they're pulling out, if they were publicly traded, right, you would still have to take care of your shareholders because they're the owners. So my point here is simple and straightforward, right? It's very easy to say a particular thing about a bank, but if you want to look at the management, if you want to look deeper into the bank, you have to look at the management of its sources of funds, the liability side, and its uses of funds, the loans or the assets, okay? And the reason you're doing this is because the source of funds directly impacts interest expense. And that is the most crucial cost that the bank faces, right? How much do I have to pay out in interest to attract, right, depositors' funds, okay? So if I am having to borrow that money from the money markets on a regular basis, then that's expensive. If I have it in the form of customer deposits, that's relatively cheap, okay? If I look at my uses of funds, and I then have to look at my asset structure, and this directly impacts my interest revenue, right? And the operating expenses. So I have to be careful, right, that I don't just lend money out at poor interest rates, nor do I have so much costs incurred to lend the money out, okay? So that means that I have to be really good as a bank management at managing operational and credit risk. Not just credit risk, but operational risk as well. Because, right, if I have problems with operations, it will cost me more, right, to raise the money, okay? It'll cost me more to lend the money, okay? So I have to try to keep my operational and my credit risk down. In other words, keep the risk of doing those things within manageable levels, okay? Right. So what are the risks that a bank faces? We have liquidity risk in a bank, okay? And the first thing we think of when we think of liquidity risk is when cash flows due to the depositor's withdrawal or loans exceeds cash inflows, new deposits, loan repayments, a bank is experiencing illiquidity, right? A bank is experiencing illiquidity. Now, the reason that's important is straightforward. The first rule of finance is OPM, other people's money. And a bank is using their depositors' money. So there's sufficient money on hand to be able to do what? Meet the liquidity demands of their liability customers or their deposit customers, okay? If they have illiquidity, then people get nervous and think, oh, wait a minute, they can't pay me back my money because you've entrusted your money to the bank, yeah? So can you imagine if you walk into Commonwealth Bank or First Bahamas, Bank of the Bahamas, and you want to withdraw $10,000 in cash, and they start telling you all kinds of stories about, you know, this, that, and the other. So then you say, okay, right, I want $5,000 in cash, close my account and give me a manager's check for everything, okay? That's not what they want to do. They don't want to give you any opportunity or any reason to close their account, your account. So they will try to find a way to accommodate you by giving you the cash that they want. They do not want the reputation or the risk of a reputation out there that they don't pay their money, pay the depositors' money when they ask for it, okay? Yeah. So what does this mean in general of management principles for a bank? It means that the bank's managements need to reduce cash outflows or increase their cash inflows, right? Okay. If they are going to stay liquid, right, they have to come to a balance between their cash outflows and their cash inflows, okay? In a general sense, it is always easier to increase inflows than to reduce outflows. What that means is it's really difficult, right, to cut down the amount of loans that you're making without having a really negative impact on your bank. Because you make commitments and then the loans are drawn down. The minute you agree to a loan, it doesn't flow at the bank immediately. It may take a week, it may take a month. But once you've made the commitment, the bank is bound by that. They have to meet their commitment. So therefore, it's easier for you to reduce your inflows, to increase your inflows, because you can always do what? You can go and borrow additional funds from the market, the money market in particular, right? You can borrow it from other banks. You can borrow it from the Federal Reserve or the central bank. You can borrow it in the form of commercial paper. You can do all sorts of things, okay? Yeah. So it's easier to borrow funds, right? Or to sell assets than to turn around and reduce your loan outflows, okay? So one of the things that bank management has to be concerned about is a temporary shortfall, right? Because you will cover most of your basic outflows quite easily. But that temporary, that blip, that time when you spend more money in the month than you anticipated, that's when you need to be able to cover this temporary shortfalls, right? And most banks will do that by borrowing from the money markets or from the central bank. Now, when we looked at money markets earlier in this course, we saw where there was a lot of different instruments that a bank could use to cover a short-term short-term gap in their funding. Yeah? So one of the things they could use commercial paper, they could use borrowings from the central bank, they could borrow from another bank, they can use bankers' acceptances, they can use negotiated certificates of deposit, right? They can use repos, they can use all sorts of things, okay? And we went through the majority of them. So what you've got here is a bank can find a way to get additional funds to satisfy its outflows if as necessary, okay? Right. Now, if they have a permanent need, or they have identified a permanent need, right, for additional inflows or additional liquidity, then the best thing they can do is they can do it by raising more deposits, right, or selling some of their liquid assets, such as T-bills or short-term investments. So what are we talking about? What I'm saying to you is they can have a temporary shortfall, but management must monitor their liquidity position to see how much money is going to be going out of the bank on a daily basis, weekly, monthly basis, so that they can say, okay, we cannot fund this doing X, we have to do Y, okay? And if they see there's a persistent issue with this, then they can decide, well, wait a minute, maybe it's better for us to raise the interest rates or have a savings account drive or deal with the fixed term deposits to get more depositors' money in the bank, okay? After you've done that, what comes to mind or what pops up to management in any bank is the asset composition can affect the bank's liquidity and thus its profitability. Now, we're not talking about liabilities now, we're talking about liquidity. Sorry, we're talking about loans, right? So how your loans are derived, right? How your loans are set up in terms of maturity can affect the bank's liquidity and its profitability, okay? So if you put 95% in mortgages, right, you get profitability, and 10% in T-bills, you'll get liquidity, right? Now, what is this 85% referring to? If you put 85% of your funds, right, your source of funds or your depositors' funds into mortgages, you can be very profitable. If you put 10% into short-term assets like T-bills, you will be liquid. If you reverse that, you'll be very liquid and not very profitable, okay? Because you make your biggest return on lending the money to borrowers. You make your smallest return by investing in money market instruments compared to loans, that is. Okay. Okay. All right. Now, between these two extremes, management must balance these competing requirements. The bank has to be liquid and profitable over the long term. Okay. And liquidity problems can usually be an advance warning sign that there are other financial problems at the bank, such as significant loan defaults. Okay. Now, at this point, I'm just going to try and give you an example of what I mean when I talk about a bank asset composition. Okay. Now, Bank of the Bahamas, right, has a loan book when I was there that was composed of the majority of their loans were mortgages. Then they had consumer loans like car loans, vacation loans, small construction loans for adding on things and renovations to houses and so forth. Vacation loans, school fees loans, unsecured short-term loans like 3 years or 18 months and so forth. Okay. All right. Now, one of the problems they faced was that their mortgages, right, became past due. Excuse me a minute. It's raining. I just have to close my windows. Give me 1 second. Okay. Sorry about that.
Mr. Fountain,
I'm sure you missed me, right,
can you
Shawnette?
can you go back to the screen right before this one, please?
Fountain.
That one?
Yes, sir. Thank you.
Mr. Fountain, you said something?
I said, I'm sure you missed me, Shawnette.
I surely did.
Okay. So we were talking about Bank of the Bahamas and how management has to handle its asset composition. Okay. Oh, this rain really coming down. Is it raining by y'all? This looked like an all-night rain. Give me a second again.
Yeah, it raining by me too.
Mr. Fountain. Hello?
Carla, he stepped away for a minute.
I have to, where have I gone?
It raining by you?
It was raining.
This must be all.
Well, Well, it's definitely raining by me. and
Yeah,
it's
it raining
Mr.
by me
Pumpkin, my
too.
electricity gone off.
Who is that? Colette?
That's
Carla.
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 I had to sign in on my phone.
Okay, if it doesn't come on, just listen to the lecture. If it doesn't come on before the exam, right, I will, you'll just do the exam later, okay?
Okay,
Because you're gonna need to be able to type and so forth. How could
yeah.
BPL do that to you? I don't
Y'all
understand
on
it.
y'all on to be next, because I right off Charles Sanders Highway, so it look like it's moving up.
The atmosphere, Carla, because it hot.
I far from y'all, so they better don't come this way.
The rain to cool it down.
Yeah, but
It
then,
was raining here first, that's why.
oh, okay.
It was
All right.
raining by me too from glass down.
Okay, so let me hurry up and get through this, please, so that we can try and be prepared for the fact that the power may go out, okay? So what I'm trying to say to y'all is a bank's management has to manage the mix of loans. It's not just make loans. It's what type of loans are you going to make? How long will those loans be out there for? 3 years, 6 years, and you need a mix. So you have a mortgage that can be 30 years or 25 or 20 years. Most mortgages in the Bahamas run about 20 to 25 years. We don't have very many 30-year mortgages, okay? So you've got mortgages going out 30 years. Then you're gonna need to have some loans that are going to be in that mid-range, from 7 to maybe 10 years. That's when you find loans for vacant land, right? And loans for construction, for additions to houses and so forth. And then you're gonna have loans that are gonna be from about 3 to 5 years, yeah? And that's when you start getting into used cars, new cars, and so forth. Then you're gonna have loans that are gonna be less than 3 years. Now you're starting to look at plastic, you know, credit card, debit card, cash advances, and so forth, which are usually at the most, okay? So the point is that management has to look at the asset composition to ensure that they are managing their liquidity, because all of those loans going out, right, are going to take away cash that you have in the form of your liabilities from your depositors. So you've got to manage that. And a bank management spends a lot of time managing that cash position, is what we call it, okay? Now, not only do they have to manage that cash position, but there is something that happens in a bank that affects its liquidity, and it's called mismatch, right? And that is because the banks, in essence, right, borrow money short. The depositors' interest, the depositors place money in the bank for up to 1 year in the form of a fixed term deposit. But most deposits are easy access, they can get at within a day or two. However, a bank makes a loan that is what, 3 years, 5 years, 7 years, and some cases 25 years. So you can see that mismatch is created between your funding or your sources of funds and your uses of funds. And that mismatch affects your liquidity. And that is why banks spend so much time, or bank management spends so much time monitoring the liquidity of the bank. And that is not just how much cash is in the cashier's till, how much cash is in treasury. No, it is how much cash you have across the bank and it is going out today and coming in today. Yeah? You understand what I'm getting at? Give me a hallelujah or amen. It's raining and it's been really dry. No answer?
Hallelujah.
Oh boy, it's going to be a long night tonight. Okay, so banks, when they're managing their liquidity, right, have to ensure that their balance sheet and their income statements are robust. They have to be in good financial health, right? That's the only way they're going to be sure that they can get the liquidity, right, via borrowed funds that they need. If the bank is in poor financial health, like Bank of the Bahamas was a few years ago, right, none of the commercial banks were prepared to lend them money. Okay? Bank of the Bahamas could not borrow money from Scotiabank or Royal or First Caribbean or Fidelity because those banks were concerned that the Bank of the Bahamas might fail and not pay them back. Okay? Because they were in poor financial health. Now, if Bank of the Bahamas at that time had a liquidity crisis or needed to get more cash in to meet its outflows, they would have had a big problem. Okay? There were a couple of times when I'm sure that arose, but it was not, it was resolved. It was taken care of. Okay? Now, why is this the case? It's simply because a potential lender, that is Royal Bank lending to Bank in the Bahamas, right, is going to be very concerned about the risks they will not be repaid. Okay? So when we look at that, we now start talking about managing credit risk. Okay? And banks focus on their net interest income or net interest position. And that is the difference between the interest they paid to their depositors and the interest received from their borrowers. Okay? All right. So remember when I've said to you all throughout this course, banks are always in the middle, right? They're in between the surplus unit and the deficit unit, right? Okay? So they're in between the depositor and the borrower. So the net is what they live off of. The margin is what the bank lives off. And the most important margin that they live off is the net interest margin, right? The difference between interest paid and interest received, okay? Right? Now, if you go to your text and you look at page 19, chapter 19, exhibits 19, 1 and 2. Don't worry about the page, just look for the exhibit. Right, and 19.3. Everybody see that?
Hold on 1 second.
Everyone there?
Yes.
Okay, so what you're looking at here is in 19.2, the impact of increasing interest rates on a bank's net interest margin. If the bank's liabilities are more rate sensitive than its assets. So if the depositors are very, very aware of interest rates and are sensitive to any change in interest rates, such that if rates go down, they may pull their money out of the bank, right? Then the bank is going to be faced with a squeeze in its net interest margin, okay? And so in this graph, they're showing you the percentage or the interest rate versus time, okay? And the difference between the interest rate on loans and securities, right? Okay, that is the red, and then the cost of the funds that they use to invest in those loans and securities is shown in blue. And what happens is, if those interest rates for the blue line is sensitive, price sensitive, then they have to pay more for their deposits. So they get squeezed and they will not be able or find it difficult to increase the loans, the interest rate on the loans that they have lent to their borrowers. Now, the way banks have gotten around that traditionally is they use a floating rate. So right now, if I wanted to borrow money from Commonwealth Bank to purchase a used car, they may charge me prime plus 4%. Okay, if they do that, right? If they have to pay more, if their deposit rates go up, right now everybody's paying like 1 or 2%. If they were to go up to maybe 4% on the payment of deposits, right? The bank is still protected because the prime rate will be adjusted to reflect the increased cost of the funds. So that spread can go up and down, but because you're using your floating rate mechanism to price your loans, that spread can be maintained. So even though it's a possibility that management can be faced with a squeeze on their interest margin, by using a floating rate, it minimizes the potential for a squeeze due to depositors' rates rising. Okay, and then the next bit is the impact of decreasing interest rates on a bank's net interest margin if the bank's liabilities are more rate sensitive than its assets. Okay, so what you're seeing now is the opposite. Okay, yeah. Now again, that's where the floating rate helps the banks because again, if the cost of funds are going down, right, or the interest rate in the margin is going down, in the market is going down for their loans, right, they can push their deposit rates down as well to maintain the spread between the two. Okay, yeah. So all of this is just to say management of a bank must be aware, right, and must manage certain things to ensure that they manage their net interest margin, right, their liquidity risk, okay, and their interest rate risk, which is going to be the next thing we're going to look at, okay. And just as another example, when I worked for Barclays Bank in the offshore side of the bank, right, we used to do a daily, what we call a mismatch report that showed all of the cash outflows in US dollars and all the foreign currencies, as well as the inflows of US currency and for other foreign currencies. And we will put that on in a simple sense, on an Excel spreadsheet, right? And we would show that the amount expected on any given day out to 6 months, yeah? And we would start off with, if we did it for today, the 30th of March, how much we expect to get in today, and then it would be the 31st of March, then it would be the 1st, and for the first week, first 7 days, it'll be by day, and then a week later, then after that, it'll go by week, and then after that, it'll go by month, and then after that, it'll go by quarters. So you could see what is coming in and what is coming out in a graphic form, and you could adjust it. And as you got closer and closer to any one date, you started looking at it on a basis of a daily basis. Okay, so that was one way that you could take a look at your liquidity, such that you could see whether or not you had a problem within the first 5 to 7 days of the week, and then whether you had a problem further out. Okay. Now, before I go on, does anybody have any questions about that? Okay. This is pretty basic stuff. You may know it, but you may not have seen it from the perspective a little higher up in the bank, right? And the risk it poses to the bank and what you can do about it in terms of how your asset composition is made up. So anybody, any questions? Carla, no questions? How are you going to be a manager, Carla, if you ain't going to ask no questions and know all this stuff?
I'll be okay.
Oh, I agree with you 100%.
We do a lot of in-house and training.
Hmm.
Yeah. So
Okay.
the stuff that I learned from you, I will carry with me.
I am so happy to hear that.
And
That's
I will
good.
apply those thoughts when I get into my
Yeah.
work. And I say, you know what, Mr. Fountain did teach us this, you know.
Yeah, that's good. And you should tell them things like, you know, they better make sure that they give you a promotion
Well,
because you know that stuff.
I think it's coming.
Good. Well, I hope it does for you. That would be really good.
Yeah.
All right. So going on to managing credit risk now. Okay. So the bank funds are either used to either make loans or to purchase money market and or other debt securities. Okay. So think of it like this. You got the depositor's money and it's sitting in that bucket, some of the contents in that bucket into loans, or do you put some of it into money market instruments or other short-term debt instruments? Either way, right, whether you put them all in loans or you put them all in money market instruments, you're going to end up taking a risk, a credit risk, because you are lending the money to somebody else. Repay you. Okay, you know, all your friends who you lend $100 to or $300 to, and they never, a whole bunch of excuses, is always the risk that that someone will do that. Okay, so in each case, the bank is a lender when it makes these things, these loans, or makes these investments, and for exposed to credit risk. So the type of loans provided and the securities purchase determine the credit risk of the entire portfolio, or what we call the loan book. Okay, all right. And then we also have guarantees, which is an off-balance sheet, also exposes the bank to credit risk. Now, the point you have to remember here is, okay, nothing is riskless. Okay, there are some things that come very close, such as government securities, but basically, if you are going to lend somebody money, there is a risk that they will not pay you back. If you buy a debt instrument, a bond, a fixed term deposit, a negotiable certificate of deposit, right? You are lending somebody money, therefore, there is a chance that they will not pay you back. Okay? Yeah. Really important that you understand the risk associated not with just one loan, but with the entire portfolio. The entire portfolio. Okay? Right. And so the people in credit risk management in most banks are tasked with managing the loan portfolio of the bank. They're not tasked with trying to find places to lend the money. They have tasked with saying, okay, we have enough money in one particular area. We have to stop putting money into that. So if we were to look at it in terms of car loans, right, they might say, no, we don't want to put any more money into car loans, right? We already reached the limit as to which we're prepared to accept credit risk on, right? So that would mean that credit risk management would then turn around, and when someone comes into the bank and wants to borrow money for a car loan, the credit people will turn around and say, no, 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 we're not doing that. Okay? The loan officer gets really mad because, his job is to go out and find a loan. And he's found someone to borrow the money, and then they're saying, no, they ain't going to lend it to him. Not because the person isn't creditworthy, but because they do not want to increase their exposure to more car loans because they have enough credit risk in the portfolio associated with car loans. Okay, that's a very difficult thing for loan officers and for staff who are not in that area to appreciate, because they figure, look, the bank is there to lend money, why you don't lend the money? Okay, all right. So now we know that banks are very good at assessing credit risk, okay, or the credit worthiness of potential borrowers. Okay, so I'm gonna ask my good friend Carla. Carla, how do you assess the credit worthiness of a potential borrower?
I do it with the 5 C's, which is character. What else? Character. I reference them on the capability or the capacity for them to pay.
So hold off on the 5 C's for a moment. What's the purpose of the 5 C's?
To know your customer.
Okay, not in terms of compliance though. Right.
Yes, for compliance reasons too, because you want to make sure that whomever it is that you are serving is eligible to get the loan.
Okay. Most times when you look at the 5 C's, you're doing what you're saying, but not for the compliance reasons. You're doing it to say, who is this person? Okay. I never met them before. I don't know nothing about them. And if I did meet them before and I know something about them, is it information that is useful for me in trying to assess the credit worthiness of this person?
Right.
Yeah. Okay. So what banks do is they use the 5 C's of credit, right? And they use risk-based pricing. What that means is the more riskier the loan is the greater the risk that is perceived by the bank for a particular borrower, then the higher, the greater the return that the bank is going to demand, which means that they will have a higher interest rate than someone who has a risk base that is considered to be lower. Okay? So in more practical terms, right? People can lend, the bank will charge me, right, 10% to borrow a car loan, and then they will charge somebody in their 20s who's just gotten their first job, maybe, right, 12% for a car loan. Now these numbers are made up, but you see the difference. I'm a lot older. I have been working for longer. I should have some money saved up. Someone who's in their 20s on their first job does not have the same sort of financial risk profile. Okay? So the 5 C's of credit is to help the bank turn around and say, okay, these people can qualify because I've assessed these basic characteristics. And then I'm going to implement risk-based pricing, which says, based on the risk that I saw these come up out of these 5 C's, I'm going to put them within this range. The worst, 15%. The best, 8%. Okay?
Right.
Everybody understand what I'm saying?
Yes.
Okay. So the 5 C's, right? In different places they come up, they use different words, but they're all coming back to the same thing. Who is this person? The first one we talk about is character. In some places they use credit history. And what would character be, Carla? Is there anyone else, sorry, before you answer, has anybody else ever been a loan officer in a bank? Okay, I'll take that as a no.
They don't like answer you, eh?
No,
Yes, sir.
no.
Thank you, Carla. And maybe I needed to say it in that tone. Okay. So character or credit history.
Right.
Carla.
Character would be basically, like you said, it's the credit worthiness. It determines like the type of person who is applying for the loan, whether or not they had credit history with us before, whether or not they actually have a bank account or they bank with us, where they work, how long they've been working, if they're were on a job that's very stable.
Okay, slow down. So if we say character, we're talking about the person's character
Right.
themselves. You know, if they come in to do the interview, when you're talking to them, do they seem to be really nervous? Do they seem to be lying? Do they seem to be trying to do something that is dishonest, right?
Mhm.
Or they're trying to scam you, or they're trying to pull a fast deal or something like that. So we look at
Right.
that type of character.
Right.
We also look at their history in terms of their financial history, in terms of any loans that they would have had in the past, and
And their
how were those
repayment
loans, right,
repaid.
and how were those loans repaid? If they were paid on time, were they repaid early, were they repaid late, did the loan have to be rewritten, and so forth.
Yeah.
Now, your competitors, other banks, will not necessarily give you that level of detail. The credit bureau that is coming into that is going to start impacting Bahamian consumers will give you that level of detail once it's built up. Okay.
Mhm.
So the credit history, sorry, the information about their loans and so forth, right? The best place for you to get that is your own bank records, right? Usually people come back to the same bank that they borrowed successfully from the first time. Okay. So if I borrowed money for a car loan when I was in my 20s, I will come back and borrow that money from that same bank, probably for a vacation loan or for a piece of property. Okay. So the bank that's looking at the person's character is looking at those two basic things. The person's individual character. Do they come across as honest? Right? You know, would they lock up in prison for thief and money? Okay. If they had a whole bunch of child support and they ain't paying it, if you can find that sort of stuff out, it is telling you about their character. If you find out about their financial history, it is telling you about their character, because, right, most people will try to repay their debts. Some people will not pay you. End of story. They just don't think that they should pay you, and they won't.
Right.
Okay. And you don't want to lend your money to that person, okay, as a banker. Okay. The next C is capacity, right? And this is where the lender needs to determine whether the person, the
And
potential
pay
borrower, can
and repay.
comfortably, not repay, can comfortably afford the payments. Now, this is something that a lot of lenders and banks in the last 15 years, last 20 years, because banks have become much more sales oriented in the time, and not just here in the Bahamas, all over the world. Okay. This is something that a lot of banks are struggling with getting their lending officers to understand. It's not whether or not that they can pay, but can they comfortably meet your payments, right? Someone could just barely make it under the threshold and make the payments, but they're struggling because if something happens, they're in trouble.
Right.
You don't want to take that risk as the lender. You want someone who can comfortably meet your $500 or $700 a month car loan payment. Okay?
Right. Yeah.
You don't want them, oh man, I depended on overtime, and the overtime wasn't there, and my wife is do two jobs, and the second job she get laid off from. That's not what you want. Okay. So we check this by looking at the debt service ratio, and debt service ratios can be manipulated by your borrower. Okay. And it's up to the lending officer to try and look at that with a magnifying glass. You can't just accept that. You have to go behind and see where is the source of this person's money when it comes to the debt service ratio. Okay, so lenders look at capacity, right? Can you comfortably afford your payments? Okay, yeah. A lot of people can look like they can afford it, and 6 months later, you wonder what happened. The next one, capital, right? The source of repayment, okay? The capital represents the savings, the investments, and the other assets that you can use to help repay the loan. Now, as people get older,
That door ain't closed.
as
Watch
people
it.
get older, as people get, Martine, you got to keep your mic off.
Oh, sorry.
Okay. Okay. So as people get older, they tend to have worked longer so they can accumulate more capital. Not always, but most times. And that means that they've got a bigger cushion with which to assist them if things were to go wrong. So a bank is looking at the capital or the source of repayment. Now that seems pretty straightforward. Oh, I got a job, that's it. But what if the person is self-employed, Carla?
Right.
Okay. What if the person has a steady job but don't have much savings? Okay. Yeah. What if they take all their savings and put it into their down payment? So now they got no cushion. The minute
That's where
something
credit risk
happens,
come in.
what do you mean where credit risk come in? Like
That's
how?
where the risk comes in with the bank lending. So when the bank lends some money to someone who has a predicament as such, like you say, maybe the husband isn't working or some kind of issue going on, then they'll have to determine whether or not they still want that loan to go through to see if they're able to pay.
Okay. What you're talking about is correct. Credit risk does come in there, but that is internally within the bank. You as the
Right.
loan officer have prepared the loan, and now you send it up to credit risk to look over it to see if it is meeting the standards that credit risk has set for loans of that nature. Yeah.
Or if they're
So
willing to take that risk.
that's exactly right, if they're willing to take that risk. Okay. So banks are looking for the source of repayment, and they want to know that there is sufficient there to cover them, or the customer has the opportunity to build up sufficient to meet a contingency as well as meet their regular payments. Okay. Collateral. One of the first things you learn in a bank as a lender is don't lend without security. Sounds stupid, right? If you're in the business of lending money, then lend the money, right? But in terms of credit risk, it makes sense. If you can have security, it reduces your credit risk, the risk that the borrower will default. Okay. Now you can make unsecured loans, and they can be comfortably handled if the person has sufficient capital and so forth. But you're basically trying to always get a secured loan, right? Collateral.
Right.
The security behind the loan to ensure that there is something there that if everything goes wrong, right, you can still get your principal back from the sale of the collateral.
Right.
And then the last one is conditions. Your lenders or banks want to know how you plan to use the money or the loan's purpose. Now, a lot of Bahamians, when I was doing lending, right, got really upset when you would ask them about what you're going to use this money for, the purpose, right? And they would just say things, man, listen, I got the money, I can pay you back. I showing you everything exactly what I can use this money for. And a lot of the times they just lie. They come right out and just say, I can use it to go on vacation, or I'm going to use it to do something that they're not planning to use it for, because they think that it's something that you should not need to know. However, it is probably, right, one of the most important things that you need to know. Okay, because if the guy is going to plan to go to Las Vegas and gamble, there's a good chance he may not be able to pay you back, because no matter how good a gambler you are, you will eventually lose everything. Yeah, because that's why the casinos and all the rest of them are in business. They're in there to make money, and they make money when you lose, not when you win. Okay, so we want to know, what is the purpose of the loan. Okay, are you going to start a, I don't know, a drug business? Yeah, that's illegal. We don't want to finance a drug business in the Bahamas. So banks use the 5 C's to assess the credit worthiness of potential borrowers. And so they try very hard to get this right. Even though you may not see these specific things on a bank's credit policy or in their credit manuals, the basis for them are there. And I know, having done some work for Commonwealth Bank once or twice, that you have in Commonwealth Bank information in your credit manuals that addresses each one of these things and more. Okay, so that's how a bank can manage its credit risk. Okay, now we can talk about risk-based banking. The power come back on yet, Carla? Carla, has the power come back on?
Yes, yes, it's on. I don't know
Great.
for how long though.
Well, neither do I. I would agree. Okay, so any questions about the 5 C's from anybody other than Carla? Actually, ask Carla, because she knows this stuff cool. Any questions about the 5 C's or assessing credit risk? So Martin, would you lend me some money? I need like $6,000 to go on vacation. I want you to lend me that for like 3 years unsecured at about 6% interest. 5%.
It's rough right now. The bank ain't letting up no money.
What's that got to do with me and you? As your boy, you ain't gonna lend me the money?
I gotta wait till the people who owe me now pay me back.
So you're telling me something that you don't want to tell me? Just come right out and say it.
My check money up busted yesterday.
The chipmunk? What'd she say?
Disregard, Mr. Fountain, disregard.
Okay. All right. So the question that I asked Martine, right, is the question, right, that is asked of Carla and other lending officers and banks in the Bahamas every day. Am I right, Carla?
Yes.
It's unfortunate, eh? And they just get so upset when you trying to get information and they telling you all this stuff, and why you ain't just gonna lend me the money? I'm always amazed at that. However, after Carla has done her assessment, or the lending officer has done their assessment
Right.
and looked at their application, the customer's application, they then have to take into consideration what we call risk-based pricing, right? And the loan interest rate is based on the perceived risk of the borrower, okay? And then to keep track of that and to use that information, every commercial bank uses a rating system to determine the riskiness of the borrower. Commonwealth Bank does it, Bank of the Bahamas does it, right? CIBC, every bank, right, in this country that lends money does that. It's actually a requirement by the central bank, but that's a different story, okay? And then once they have been slotted into this rating system, right, and the rating comes out, this will determine the margin to be applied to the loan. It doesn't determine prime rate, it determines the margin. The prime rate is fixed. If it's 4.25%, then the margin is either going to be 2 or 5 or 7 or whatever. Generally speaking, right? If it's unsecured, the margin is the greatest. If it's secured, the margin goes down. If it's secured in the form of tangible assets like real estate, then the margin can come down a little bit more. Okay, that is from unsecured. Yeah. But generally speaking, after that, it all comes down to the perceived risk of the borrower. And credit risk management in every bank looks at your application, the customer's application, right? And puts it into a matrix depending on the answers that they get, or an algorithm it's called, to come up with the rating. The best rating you can have is a cash secured loan for a short time. Right, Carla?
Yes, sir.
The worst rating you can have comes from an unsecured loan for a long time.
Right.
There you go. So between those extremes, you get different types of ratings. Borrower risk rating systems help you to implement that, and then credit risk management enforces.
Mr. Fountain,
That is the basis.
Mr. Fountain, I'll give you a cash secured loan for $6,000 for 18 months at 5%.
That's really good. Thank you so much, Carla. Right? Okay. Now let me see if that's worth it to me. If I took that same 6,000 that I have there, I'm only getting 2%, less than 1% fixed term deposit. So I'm gonna take that out and I'm gonna put that into a money market instrument, right? Through Leno, and I might get as high as 3%. No, I'm not gonna do that. I'm gonna take that and I'm gonna buy government registered stock, which they just advertised, right, with a tenor of 1 year for 3%. So sorry, Carla, I can put that in for 3%. So your 5% can cost me 2%. Now I can use my own money. Sorry,
Okay.
Carla. By the way, did anybody see that advert in the newspaper last week for the new issue of government registered stock? They were paying 3%. How much do you pay on a fixed deposit for a year in Scotia, in Commonwealth Bank now?
It's 0.25 or 0.75.
And you want me to lend you $6,000 that you are then gonna lend back to me at 5%? Carly, you trying to rip me off, man? What kind of bank you trying to? What this is you doing? I ain't listening to you no more. You was my girl, but you messing me up. You're trying to take bread out my mother mouth and my father.
I still try to help you because Martin wouldn't lend it to you at all. So I let you weigh out your options.
Okay, thank you. I appreciate that.
Okay.
Okay. Now, because we use risk-based pricing, there's always the tendency, right, to try and skew your book in consumer lending in particular towards higher risk customers, right? Because you will get a higher return. You can charge a higher rate of interest. So the bank's management, especially senior management, have to do a balancing act between credit risk, right, and return. Do I take a spread? Do I get a mix of credit risk, or do I stick with a really high quality borrowers and get a low return? Or do I stick with high risk borrowers and get a higher return? Okay. Right. So that's the balancing act that they have to do. And that's not on each individual loan, that's across the entire portfolio. So they're not looking at one loan, they're looking at all the loans that fall into different categories, right? Then they have to minimize the credit risk results because they will get very low returns. And they want to maximize returns, which will result in greater profits, okay? So this is called the risk-return trade-off, and it must be managed by commercial banks. It must be managed by commercial banks. And if senior management is not doing this, right, or not doing it well, they ain't gonna be senior management for long. Okay, not in a publicly traded company. Now, where can you see this? You can see this risk, credit risk and return trade-off in the composition of the bank's loan books. Okay, yeah. Now, I'm not picking on a particular bank, But because Commonwealth Bank is known as a consumer lender, they tend to have higher risk loans. Sorry, not just consumer lenders, but they can do a lot of unsecured loans. They tend to have higher risk loans and higher returns than Bank of Nova Scotia or say Royal Bank. Okay. So we come to the end of this portion of the lecture, right? And we say straightforward, the goal of bank management is to maximize shareholder wealth. Okay. That's the goal of bank management, right? And banks must manage liquidity, right, by maintaining liquid assets, because it's easier for you to bring money into the bank than to stop money going out of the bank. Okay? Banks must manage the interest rate risk. Okay, yeah, that spread that we measure using the net interest margin. Okay, and this is because they borrow short and they lend long. The depositors' money are in the bank for short term, and they lend money out for up to 25 years. That is a major, major mismatch. And we call that borrow short and lend long. Okay? Banks must use matching maturities of assets and liability to reduce their mismatch positions. Now, what that means is if you have a loan that is going to mature in 5 years, right, then you have to make sure that you have deposits, right, or money that will be available, right, over the length of time that that loan is out there. Okay, so you've got to be able to match the maturity of the assets and the liabilities to reduce this mismatch position created by borrowing short and lending long. And that is one of the reasons why banks love to let you put your money into fixed term deposits, but they won't give you the lowest rate possible, right? But they want you to put that in there and keep it in there for 5, 7 years if they can, okay? But they're not going to give you a floating rate 5-year fixed term deposit, okay? They want you to put it in at a fixed rate because that will minimize the interest expense. Any questions about this? I ain't bore you all to sleep yet. Dominique, I haven't heard one peep from you. Nothing from you, Miss Whitfield, and I heard something from Miss Cartwright.
Yeah, I answer you a couple times.
Okay, good. How about you, Miss Whitfield?
I'm right here, Mr. Fountain.
I ain't bore you to death yet.
No, sir.
What does it mean when we say a bank borrows short and lends long, Miss Whitfield?
Can I ask for some help?
Okay.
I'll ask Shawnette.
Okay, Shawnette.
What was the question?
What does it mean when we say banks borrow short and lend long?
Let me think. Hold on.
You could get a lifeline.
Martin, come in, Martin.
Hello, Martin. Calling all Martin. We need a lifeline.
But what the question is again, please?
All right. What do we mean when we say banks borrow short and lend long?
That means
I could guess.
that's when the banks raise their capital by taking deposits. That's
I think it has
available
something to
short
do with
notice.
like she said,
with capital as well.
When they lend out money, what won't be available to them for long, right?
I think I could help.
Like,
I think it's like,
Go ahead, Angelique.
Okay.
Angelique or Shawnette, go ahead.
I guess, and Mr. Fountain, don't quote me. Yeah, I think it's, I think it's when they somehow raise capital or something like that by taking deposit some kind of short notice, and then they lend out money, which won't be available to them for like a longer period or something like that.
Okay. And you, Angelique?
Okay, I would say 365 days term deposits would be borrowing short, and mortgages would be lending out long.
Absolutely. Right? Banks borrow money from their depositors. You all agree? If you put a deposit into a 1-year fixed term, if you put $10,000 into a 1-year fixed deposit, you won $10,000, or the bank borrowed it, right, for 1 year. So they borrow short. In other words, they borrow their depositors' money for a short period of time, usually only 1 year or less. And then they lend the money out for what? 3 years,
30-year
5
mortgage.
years. That's correct. 5 years for a car loan, 7 to 10 years for a piece of vacant land, 25 years for a mortgage, 30 years for a mortgage. Right? So that 1-year deposit has to keep rolling over, right, to fund those deposits. Yeah? That's the long part. Banks borrow short, borrow their depositors' money short, and they lend long. They lend it for greater than 1 year. The only thing that you can borrow, not the only thing, one of the few things that you can borrow money short in a bank is through your credit card, right? That's it. Yeah. Why do banks make loans that are reviewed every year? Right? Because they want to be sure that the credit risk is acceptable to them every year. And therefore, right, they can make sure that the money that they need, right, in terms of their borrowings is available. Okay. That mismatch between the amount of money and the time they borrow it in and the amount of money they pay out and how long they pay it out for, right, is a mismatch, on a bank's balance sheet. And that can cause liquidity as well as liquidity as well as interest rate risk problems, right? And more banks have gone belly up because management have not managed that particular risk or mismatch very well, okay? And even though you may not see it as a bank employee, that is being done on a regular basis. Actually, every day they look at that, okay? So that's what it means. I might have gone off on a little bit of a tangent, but you should know that, right? If you can't come out of this course and know what that is, I ain't do a good job or you all ain't pay attention. But I know it's not that y'all didn't pay attention. Okay? So we were talking about bank management. Any questions about bank management? Any questions other than why they hire that person and put them in charge? Because I don't know. Hello? Anybody? Hello? Angelique?
No questions.
Shawnette? No questions. Miss
I don't have no
Whitfield?
questions either.
Okay, thank you, Angelique. Miss Whitfield?
No questions at this point.
Okay, how about you, Dominic?
No questions at this point, Nathan.
Okay, all right. So,
That's timing.
not yet. Unfortunately, not yet. It's only 7:30. We got another half hour, and we have a lot of
The
stuff.
fountain is 7:40.
Okay, it's 7:40. So what do you want to do? Have the test and don't continue on with the lecture?
No,
And
no,
then-
I just was correcting your time.
We can have the test and then do the lecture afterwards.
No, we're doing the lecture
Mad.
first. We have to get these lectures out of the way because I don't want y'all to say that y'all ain't get y'all money's worth from Mr. Fountain.
We get it. Once we pass, we get it.
Well, actually, that's not a bad way to look at it. If you pass, you get your money's worth. If you didn't pass, you did. Okay, fair enough.
You fighting being down.
Okay, so let us just look at the next set of slides and get ourselves going here. Okay. So what we're going to be looking at now is another type of financial institution that we call cooperatives as well as credit unions. Now, a cooperative is a financial institution, okay? And this is I like this quote the most, one of my better quotes that I found. Knowledge is realizing the street is one way. Wisdom is looking both directions anyway. And that is what banks need to remember. Knowing about something is one thing, but you have to use the knowledge as wisely as possible, okay? Because one of the things that has happened in banking over the last 25 years, 30 years, is the almost disregard for depositors' money, okay? Because they're so intent on selling things and making returns, they forget that it's a long-term business, right? It's almost a license to make money, but it's a slow business. You don't make a lot of money in a bank quickly. You make it over a long, long time, okay? And then the last one here, this is for all of y'all who take courses in BIFs. An investment in knowledge pays the best interests. And that's what you guys are doing. That's why I like that one. Okay, so Martine, I'm sure you'll tell me when it's 5 minutes to 8, so I can get this test to you all, and then we'll go from there. All right, so what is a cooperative? A cooperative is a group of people coming together, pooling their resources to help each other to achieve a common goal. So, Shawnette, is an ASU a cooperative?
I guess it is. That's a group of people coming together, swinging each other or not. Yeah.
How could you say they swinging each other or not? A cooperative is a group of
They
people
pool
coming
up.
together and pooling their resources to help each other achieve a common goal. Isn't ASU, by that definition, a cooperative?
It sure is.
No, it ain't.
Yes, Mr. Fountain, because it's if it's 10 persons throwing $5 that go into one of those 10 persons to help them get all the funds, and then it just goes around and around and around, right?
Okay, what's the common goal?
To get your hand at a date that you needed to pay something. I don't know.
Common goal is to swing.
No, but when I said it, he say not to swing.
No, because saying everybody is take people money and don't pay out. No, it's people in corporate that.
I don't
Okay,
go Jesus job.
okay. So my point is, ASUs are not cooperatives. However, they are the basis on which most cooperatives start, because people see the advantages of, right, some sort of binding together or coming together to achieve a common goal, some financial security, right? ASU is not unique to the Bahamas. It's called any number of different things in any number of different countries, right? And it's pretty much something that you will see in every country that you could think of. People do it, okay? So it's not a cooperative, but it is the basis on which cooperatives can be formed, okay? So cooperatives, right? These are consumers who use the co-op to acquire products or services, okay? And these are the people who are the users and the stakeholders. So there's the consumer who will put the money into the cooperative with the idea that I can get a particular service or I can get a particular product at some later date. And you can have them in retail, housing, healthcare, or daycare co-ops, right? Now, the ones that we know the best are probably in retail, right? And we don't see it too much in housing here. We don't see it too much in hair care, in healthcare. We sometimes see it in daycare when you may have one family within a community with a grandmother or two older women that provide some sort of daycare service for people in that community who are working and need some place to leave their children. You don't see that much, but it is here in the Bahamas sometimes. You can also have producers, farmers, artisans, small independent businesses use a co-op to process and market their goods and services or to buy needed products. Now, we see that a lot more in the Bahamas, and we actually have cooperatives in the Bahamas. Most of them are around agriculture, farmers, right? But it can be used for any number of things. The concept can be used for any number of things. But there are agricultural co-ops in some of the family islands. Unfortunately, they're not doing very well, right? But they're there. Right? And so for an agricultural co-op, what you'll see is the farmers will send all of their produce to a packing house. And then in that packing house, everybody's products are packed together in boxes, shipped to Nassau, and then the money comes back, right, with, well, you shipped 10 boxes of tomatoes. You didn't necessarily, each box had only your tomatoes in it, right? And the boxes that you use, the cost to buy them and to store them and to fold them into the right shape to put your tomatoes in and so forth would have been borne by everybody in the co-op, right? So what you're doing is you're using the co-op to assist you in getting your stuff to market, but it's not just unique to you, it's for anyone else who is in the co-op doing the same thing, i.e. selling tomatoes, okay? And then we have workers who use a co-op to secure employment and control their working conditions. Now, the best form of a co-op is basically a union, yeah? It's not the same as a co-op, but it evolved out of the co-op. Okay. Now, how does a co-op operate? Cooperatives operate democratically. You get one person or one member, and they get one vote. Okay? That means that it doesn't matter how much money you put into the co-op, you still only get one vote if you are a member. Okay? And those votes go through two bodies, the members and a board of directors composed of members elected at a general meeting. Okay? That's it. So you can see it's relatively simple. It's very straightforward. Okay? Right? If all of us in a co-op, right, because Martine has got more money in the co-op than anybody else, doesn't mean that she gets to have more votes. She only gets one vote. So all of us, right, would have to vote to be able to put somebody into the chair or onto the board of directors of the co-op. Now, how do they get their money? The co-ops usually start, right, up. They get their capital from what we call a subscription from the members. So the co-op brings together this group of people, they form a co-op, they become members, and they throw some money into the pot, which becomes the capital for the co-op, and that is what they use, right, to get themselves started. Okay. Now, when I say throw some money in the pot, the more technical way to look at it is they buy co-op shares, right, at a set price. So it's $10 or $12 or whatever it is. Okay. Yeah. So they can buy 20 shares or 50 shares. It does not impact their membership or their one vote per member. Okay. And then each member's liability is limited to the amount of their share in the capital. Okay. So if our friend Martine, who has the most money invested in the co-op, right, her liability is limited to only the amount of their share capital, not the retained earnings or anything else. Okay. All right. Now, how do co-ops differ from investor-owned companies? In a co-op, the members are entitled to one vote at a general meeting, regardless of the number of shares he or she owns. And an investor-owned company like Commonwealth Bank or Abaco Markets, right? The number of shares determine the number of votes of any shareholder. So one person or one group of people can control the company if they have the majority of shares. Okay. In a co-op, there's no proxy voting. Okay. No, but you can't give your vote to somebody else for them to cast as you have instructed them to do it. Okay. In an investor-owned company, you can have proxy voting. You can tell management, right, under their proxy regulations, which are in the memo and articles of association, and you can instruct management that you wish to vote this way on these particular topics, and they will do that on your behalf. Okay. In a co-op, you have a limit on dividends. You cannot take all of the money out of the co-op unless they're being liquidated. So you can get a return on your share subscription if the co-op is doing well, but right, it doesn't mean that you can get as much as you would like, or you can get 50% or whatever, right? They can limit what they can send to you, right? The investor, in an investor-owned companies, there's no limit on dividends because the management can act and the board of directors can pass a resolution to issue full dividends, right, if they choose to. Okay. In a co-op, generally a share does not increase in value and it's always redeemed at par. So if you pay $10 for your share, then you will get $10 back. In an investor-owned company, right, the value of the shares reflect the net value of the corporation. So if the value of the corporation has gone up, that is assets minus the liability. If the residual balance there has gone up, then the value of your shares have gone up. Okay, so if you bought them at $10 and 3 years later they could be worth $15. In a co-op, no, they stay at $10. Okay. In a co-op, surpluses may be paid to members in proportion to the business done by each member with the co-op. Notice that is not in proportion to your shareholding, right? Surpluses, what they mean by surplus in simplistic terms, net profit. If, right, they made a profit, that is after selling whatever it was that the co-op was being sold, like the tomatoes, then taking out all the expenses, there's a surplus left over, right? That can be distributed to or paid to the members in the co-op. But, right? Okay. It's only in proportion to the business that you did with the co-op. So if you didn't do any business, you don't get nothing. In an investor-owned company, profits may be distributed in the form of dividends according to the provisions for each class of shares that they have. Okay, that's it. You can't say to some people, no, you ain't getting nothing. No, you're an owner, you get a proportion of this dividends. Okay,
Gotcha.
all right. So we're
Oh,
gonna
it's
stop
it's
here.
time. Yeah, oh, yeah.
We're gonna stop here. And I am going to send you all the exam. And it's going to take me about a minute, hopefully. And you guys will be able to respond and get this over with so that Martine can go to sleep and get a good night's rest.
Right away, right away.
This is test number 5 or 4? 5, right?
Must be about 10.
5, I think.
Yeah, there's 5.
It's test number 5. Thank you for that encouraging word.
Step back, you're dancing too close. I feel a little cup come through. No, you can't have it. You know what I want to do. Like it when you like that. Why is TV on and no one watching it? Thank you very much.
Mr. Fountain, you didn't send the test?
Not yet. It's coming. It's
Oh,
coming. You
no,
know,
I
some days,
think
some
so.
days I'm not as organized as you guys are. So you gotta bear with me.
John, Mr. Fountain, not me.
Oh,
Martin, you hired it.
boy, this must even be my, this one here gonna have to get canceled out. And
Boy,
you say, Mr. Fountain, you say you taking the best for all the 6, right?
Martine, I with you. The best 2 out of 6.
Yeah. And the exam only out of 30%.
So we still have an exam and this project?
No,
Yeah. Another old project,
yes.
you must see 10%.
No, what is difficult here? Yes, you gotta get it done. This is a university level course. Get the work done. Don't moan, don't groan, get it over with. We got about 3 more weeks of classes and you're done. Let's go. Right, Carla?
How we did save this the last time again?
Okay, please tell me if you got the test. It's been sent.
I get it, yeah. But would we be, once we did go ahead and we start writing, and I thought it was something to do with save.
Have you gotten it, Carla? Ms. Cartwright? Ms. Whitfield?
I haven't gotten it yet.
I got it.
I probably need to restart my thing.
Say, once you get it, start. Just confirm that you got it.
I got it.
I got it just now.
Thank you.
I got it as well.
Let's go, Carla. You're
okay, I
looking
got
hot.
it.
It's coming, Carla. It's coming. The power's not off. It's there. You know you have blue fingernails? Your mic is on, off column. Carla, your mic is off.
I just opened it in Google Docs.
So you got it.
Yeah, I got it. Let me turn on the light.
Martine, did you get it?
Well, I trying to, I trying to sign in right now.
All right, everybody who's got it, please start, get the test back to me by 8:35 and we will be very happy.
Okay. Let me turn off my mic.
Mr. Fountain, you done it again.
Yes,
You done it again.
what happened?
Mr. Fountain, I
Yeah,
don't
I
understand.
got the first question yet.
I don't understand none. I didn't read the four and understand. Give me a 0. This I even ain't my head with this shit.
I right behind you, Martin.
What is it? What's the problem?
Paulette.
Okay,
Mr. Fountain, I feel like when you ask questions like these, it's like it's opinionated, but then if we give the wrong opinion, it's wrong. And that's why I feel like I don't ever get points for stuff like this.
okay, so what's the first question?
The first question is hard and I don't understand.
What is the first question? Not if you understand it or not. What is it asking you?
RBC Canada has 77% of its customer deposits in commercial
I
paper
almost
loans
dropped my laptop
to
and all on this thing.
financial institutions and repos. Do you agree with this strategy? Yes
Okay.
or no? Explain.
Okay, so if you say yes, you give an explanation. If you say no, you give an explanation, okay? Your explanation has to be logical and it has to make sense, okay? Yeah, that's it. Yeah, it's not an opinion. If you say yes, you have to justify why you're saying yes. If you say no, you have to justify why you're saying no. Your justification has to make sense in terms of what we have studied. So, okay, would you agree that Royal Bank of Canada or whatever it is should put 86% of their depositors' money in government registered stock? That's the
Yes.
question. Okay, if you say yes, tell me why. If you say no, tell me why. Next question.
GRS,
What's the question say? I don't have it.
government. Explain why Bahamian Insurance Company would invest in GRS.
What's GRS, Colette?
Oh,
Government registered stock, right?
that's what they
Government
always do.
registered stock. You've heard me use this term all through the course, right? Government registered stock is Bahamian dollar treasury bills, okay? Why would an insurance company invest in treasury bills? Okay? Are treasury bills money market instruments?
Yes.
So why would you invest in that? All these questions are asking is for you all to think beyond repeating whatever it was I gave you. Because you know the answers to these things and you have the information, but you're gonna have to think your way through what it is, okay? So an insurance company, why would they make an investment in treasury bills issued by the Bahamas government?
Okay.
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 Next question.
What's our next question?
BIFS.
I'm sorry, Angelique, could you say that again?
BIFS Bank engages in proprietary trading in the money and foreign exchange markets. Explain in practical terms what BIFS Bank is doing. Note your answer must be
Specific. Okay, so this is a simple, straightforward question. Do you understand what the term proprietary trading means? If you don't, you cannot answer that question. If you do, you can understand it, right? It's an open book exam. You have your notes as well as the textbook in front of you, right? It's a definition. You can go look it up and then you can use it, okay? But if you don't know what it is, you got to look it up. If you know what it is, the answer is straightforward. Okay, next question. That's 3. There's only 4 questions, I think. What's the next one?
Mr. Fountain, I don't know where to begin. I honestly can't.
No, no, no. I mean, seriously, there's a certain amount of, I listen to what you all say, but there's also a certain amount of work and effort that you have to put into this course, right? And this course does not ask you to repeat everything when we get towards the end. Now, all the other tests up until about now have been about definitions, okay? Yeah? All. Now you're being asked to apply your definitions, to use what it is you should have understood a little bit about and answer a basic question about banks, okay? All of these things are about banks. That's it, okay? Now, if you've done a little bit of work and a little bit of studying, or whatever it is you want to call it, these questions are not difficult, right? It's
I
only
think
4 and
my
6 points.
problem is I don't know how to, I can figure it out. I can figure it out. I think I get it.
Okay? All it's asking you to do is think about the definitions that you have been taught, right? And understand it so that you can say, what is it this company or this bank will do? Okay? That's it. But it is not regurgitate, right? And give me back what I have given you. It's asking you to apply a little bit of what you should, I hopefully should have learned. Okay? That means you have to put some effort into it. If you're not prepared to do that, it's going to be difficult. Okay? Good luck. You get an extra 15 minutes if you wish. You can get your test back to me by 8:45.
This Mr. Fountain really is something else. I swear.
so I could spend this day.
Hi, Mr. Fountain, can you confirm if you got my text? This is Anjali.
Okay, just give me a moment to check. Yes, I did. Angelique? Angelique?
Yes,
Yes,
okay.
I did get your text.
All right, good night.
Thank you. Good night.
I sent my exam, Mr. Fountain. Pardon me?
So Dominic, you said something?
Yes, no, I said I sent my exam.
Yes, I've received it. Thank you.
Okay.
Good
Good
night.
night.
Can you check for me, Mr. Fountain?
I will. Just give me 1 second, please.
No problem. What is and this was here. I know I saw this in this book. Same bank regulators. What chapter is the next? I found it, yes. I got it. What is the next test on what chapter? Next week?
The next test is due on Tuesday, and that is going to be on what we did tonight and the stuff on bank regulation and bank management, bank regulations. That's it, because you just did one on bank operations.
Okay, so bank regulations, bank management. All right. I can try to look at that and finish my paper. Okay. Have a good Holy Week.
Okay, did you put your name on the test? No, you did not. Okay.
Oh, sorry.
All right, that's okay. That's fine. I got it. I
All
can
right.
fix that.
Thank you.
Bye. Enjoy your long weekend.
I will.
Mr. Fountain, I just sent mine.
Okay,
Thank you. And you
I
said
have it.
the next
What was that?
the next test would be on.
Bank regulation and bank management.
Okay, and that's our last test.
That should be the last test, test number
And then-
6
And then the project
in the project, right?
and the exam.
The final exam, correct.
Okay, thank you.
You're welcome.
Good night.
Good night.
Mr. Fountain, let me know if you got mine, please.
Okay, I see an email from you. Let me
Just
just
make
see if I can, let me just see if I can. I just have to make sure that I can open it.
And make sure to type the information in it. I had an attachment.
Yes, I have it, and you have capitalized everything as usual, so yes. it's
Okay, good
definitely
stuff.
good.
Okay, there you go. Well, good night. Have a great weekend
You
and
too,
be
take
safe.
care. I will try very hard.
Don't mark too hard now.
I don't mark, I mark y'all so easy is ridiculous, but I won't say that. Y'all won't believe me.
These working people,
So am I, by the way. I didn't know if you remember that. You think I
Okay.
just go? Hold on, wait a minute. I just trying to do something here.
okay.
Color Pratt, Pratt. Okay, so I got yours. Yours is a PDF.
Right. That's
Yeah.
it.
I want to say to you, yes, you are working people, and I am a working person also. And I
Mhm.
also want to say to you that I mark, in my opinion, very easy.
Bye-bye.
Take up all the things. If you look at all of your, especially your last few tests, the last 2 tests, right,
Mhm.
this included. If you look at your answers and everything, you'll see where I've made even little corrections in there.
Yes.
Look at them.
Yes.
Okay.
Only because of the time frame. So I don't want to make any mistakes, but I'm trying my best.
I believe you. I really do. And I think that that is a excellent thing, because if you don't try, you ain't getting nowhere. You know
No,
what I mean?
I'm
You
going to
know?
stay positive and I'm going to try.
You're gonna be fine. All you have to do is just do the work. And the
Okay.
work is not incredibly difficult, because I have to accept that you work and you come
Right.
home and you're tired, just like I come back and I'm tired.
Yes, I agree.
So that's why you don't have notice, you guys don't have all the work you get is that you can do on your own time. Think about it. The project, the midterm, you could do it whenever. You have 2 weeks, you could do it on this weekend, that weekend, you could do a little bit, whatever it is you want to do. Right?
Yes, sir.
The test is not an hour, it's half an hour. Right? You don't have 15 questions, you have 4, maybe 5. I thought I was being nice, but I won't do that no more though. I can be my normal self.
And what's that?
Okay, you know, did you do the course at Commonwealth Bank? The basic lending course at Commonwealth Bank?
I think I did that first. There's a bunch of courses, to be honest with you, Mr. Fountain, that we are enrolled in. And every time it's besides BIFs, it's signing up for internal courses.
Right.
I just finished money laundering last month. So now we have our PAs coming up, so we have to enroll again in these courses.
Right, that's because you have to know how to do the PA.
Right.
Mr. Fountain, can you check to see if you got mine?
Don't go
please?
anywhere, Carla, just hold on. Yes,
Okay.
I'm checking. I'm going to check right now. I see something from you, Martine.
If you could open it.
I'm going to tell you in a minute. You have it in Google Docs. Yes, I have it. I can open it and I've got it.
Okay, good. Thank you. Good night, y'all.
Good night.
Enjoy your weekend.
Good night.
Good
So,
night.
yeah, Mr. Fountain, we've been doing those
Brianna.
courses in ABA.
I'm sorry. Yeah. Okay.
So they
Uh,
sign us up like with these ABA courses that we take online.
mhm. And how are
Yeah.
you finding them? Martine, you have to, yeah, she's left. Okay.
I can
So,
do it at my own pace. So, I mean, a lot of times, like now, if I finish, I could log on and then I could do it at my own pace. So
okay.
it's not too bad.
Right. In terms of the what?
Just in terms of, I guess having to compared to this class, having to the time frame and then having to complete it at a certain time.
Exactly. So you
Yeah.
can go online and you can go online at 2 o'clock in the morning or at 6 o'clock in the evening. You
Right.
don't have to be at class from 6 until 8:30, right?
No.
Whether you're tired or not or anything like that. So
Yeah.
it's better, but it's still a certain level of work.
Yes.
Okay?
Yeah. A
And
lot
if
of
anything,
reading, a lot of
and if
reading.
there's anything, I've done those courses and I've seen those outlines, and you have a lot of reading to do.
Yeah. And it goes a part
Especially-
of your resume because they save it on your file. So it's a lot of internal stuff that we do in terms of development.
Right. And let me just say between you and me that one of the reasons I believe Commonwealth Bank is doing those sort of things is because Commonwealth Bank is going through a transition, right?
Mm-hmm.
The way they used to make a lot of money before doesn't seem to be working as well. Those
Right.
loan loss provisions are growing, and you all made a loss. And you all, I don't know if you made a loss, but you didn't do so well in 2020 in your
Right.
financials. Okay.
They still pay dividends and stuff though.
Yeah, I know. I
But
follow them up.
as of I think next week we're gonna go electronic with everything. And then the credit bureau that will be added on in May. But a lot of stress was like in the branches because, well, I am going to be one of them who's going to be starting the electronic one. So they left some persons on manually. So I would be the person in the branch who directs everybody how to do the application online. Yeah,
And
so that's a lot of stress.
it is a lot of stress, but what they're doing is they're trying to adjust to the changing environment. And they're
Yes,
trying to do it by keeping as many of you all as they can.
yes, yes.
But unfortunately, as in all these things, it's a terrible thing to say, but some people are going to get left behind.
I think
Some of the
so.
staff.
I think so eventually.
Well, I like the word eventually. That makes you feel better, but it's coming,
Mhm.
Carl. You know it.
Yeah,
You
it's
know it.
coming.
And and that is going to be disruptive and people are going to get upset and they're going to do this, but it doesn't matter because the first thing that the management of Commonwealth Bank has to do is maximize profits.
Yeah.
And so, we could sit here and we could holler and complain and moan and groan and so forth, because when I was at First Caribbean, we went through the same thing.
Right.
We went through the same thing. Scotiabank, you see how many staff they dropped over the last 12 years?
Yep.
Same thing. Since 2009, see how many staff they dropped?
Yeah. Well, since
Okay.
I'm going to be the first one to start it off, I'll try my best starting next week, Monday, to get everybody up to
Let me-
par.
Let me give you some unsolicited advice.
Mhm.
Yeah. The trick with those things is simple and straightforward, right? You just have to put enough effort into using it. You will make mistakes, okay? Don't try
Right.
to make it perfect, right? Just get better every time you do another one.
Yes.
One of the problems that you all have in Commonwealth Bank with your lenders is that your narrative, your explanation of things, right, is weak. It's not
Yeah.
that you don't understand it, it's that you can't get it on the paper too well. Yeah.
Yeah, I
And
agree.
the electronic stuff is not big on the narrative, right? It's on the tick this box if it's that or the numbers and so
Mhm.
forth.
Yeah.
So it makes it a little easier for you.
Right.
Okay. But the number of good loans that you all have is decreasing
Right.
because people are so worked up in the pandemic and they ain't working and all the rest of it. So explanations become important if you're going to get something past Silbert and Franklin. Yeah.
Yeah. They like explanations.
They don't have a choice.
They love it.
They have somebody foot on their neck,
Yeah.
and it
But
ain't you.
they pretty much easy to get along with.
They are, but they got to be
Yeah.
really tough on those credits,
You have to be.
right? And
Yes.
see, and this is something that this course tries to get across to you all in a roundabout way, right? You can't just look at it from your point of view only. That's what you do on the job, right? You have
Right.
to look at it from the whole point of view of the bank.
Yeah. Well, sometimes I do have applications and I have to call Mr. Cooper and ask him. And he would be like, well, look at it from my point of view. And, Mr. Thomas going to give you a history from back in the 70s when he first started. So it's good though.
Yeah. And
Mhm.
I'll say one last thing to you. I don't know how long you've been at Commonwealth Bank, right? The Commonwealth Bank is relatively easy compared to Scotia, Royal, and First Caribbean. Doing what you doing,
Right.
them tree, that's a cut ass. That is a cut ass.
Well,
You have,
I am one of the top salespersons in the bank. Normally rating from between top 5 for the last 3 years, but I've been there for about 12 years. Yeah, so I mean, it is
if you
what it
get
is.
it,
I've come a long way because I started as a teller and I moved
yeah.
all the way up. So, and now they're training
And
us
let me
now.
ask you something. Let me ask you something. Miss Carla Kemp, if you started as a teller and you move all the way up to loan officer, and now you're one of their top loan officers,
Yeah.
how did you do that? What did you do?
I
Let me tell
think
you, don't answer. Let me tell you, you worked.
yes, I
You
worked.
surely did.
Yes, you're
You
right.
surely did. You ain't nobody give you nothing. You
No,
worked for that,
I did.
right?
I
You
did.
became a good cashier.
Yes.
And after you was a good cashier, you went into another area and you worked at that.
Yeah, I was in collections and then I moved. But then too, it comes along with attitude and if the willingness to take it on. If you put the mindset and to say that you don't want to do it, then it won't happen. So I know about that because I have challenges and sometimes I have to set my mindset to say I'm going to face it because if not, I'm going to fail at it, you know?
That's
So
exactly right.
yeah,
And
it's
this
it's a
course,
mindset.
and this course, and the courses that you're doing internally,
Right.
and the degree or the certificate that you're looking to get through BIFs requires
Mhm.
exactly the same thing that got you from cashier to loan officer to one of the best performing loan officers they have.
And I'll be on top. Mr. Fountain, I have to go, okay? Good
I
night.
understand.
Yes,
Take
sir.
care.
Good
Bye-bye.
night.
Nice talking to you.
Bye. And have a
Good
great
luck with
weekend.
everything.
Yes.
I will. Thank you.